Before I let you go, I got actually my favorite question that I ask all of our guests here, which is, what's one risk management lesson that you live by now that you wish you knew at the beginning of your career?
Wow, there are a lot of them. I don't know if I can narrow it down to one. I guess a few that come up for all tech portfolio is diversification is not your friend in tech. It took thousands, tens of thousands of companies to create the FANGs. If you think you have a FANG, we have found allocating up to 20% is a great strategy. Uh, if we are looking and talking to ETF distributors right now to see if that would be a good idea for our company. And we looked at AI ETFs that basket 50 names. They underperformed the NASDAQ during the AI boom. Not a good idea. There's no reason to underperform the NASDAQ during an AI boom if you are positioned for AI. The other one is broad market. I can't emphasize enough broad market for tech investors. This is a risk management tool because if the broad market doesn't say go, the chances a tech stock defies that and does well is pretty low. The tech really needs the broad market to participate, and that is an important risk management tool. And then third, I'm going to throw out three. Follow those stops. We cut positions that we like very much. We talked about Microsoft, and we attempt to buy lower. We don't believe in long-term buy and hold for tech because of those sentiment-driven moves in both directions. So following stops is something I wish I had known early in my career. I know it now, and it's almost as important as picking the stock.
Yeah, no, the research and the risk management are two very, very separate processes. And, that's something that we talked about earlier that I think is appropriate to end on, because I think I can't hammer this point home enough to our retail investor clients. Just because you like something doesn't mean you need to be long it. Those are two separate things. And just because you don't like something doesn't mean you need to be short it. Those are two separate things. Those are four different outcomes: liking, longing, shorting, disliking. Those are four different things. You should only put those things together in your portfolio when the market agrees with what you like and dislike from a positioning standpoint. So I appreciate you reiterating that teaching, coaching lesson that we've been pounding the table on for the past 3.5 years for our clients, Beth. This was a wonderful discussion. We'll definitely have you back on the program if you'll have us. Learned a lot today, Beth. Appreciate you guys. Where can our clients go to find you and then what you guys are doing over at IOFund?
iofund.com. Our flagship tier is the advanced tier. It comes with those trade alerts, weekly webinars, tons of deep dive research from myself, and fundamentals from a fundamentals team.
Awesome. Well, I appreciate that, Beth. We'll catch you next time. Thank you very much.
It's been an honor. Thank you, Darius.